When people ask me about the secret to successful investing, I like to remind them that it's not about having a super comput or being the smartest person in the room. In fact, investing is much simpler than most people make it out to be. The real key is patience, discipline, and a clear understanding of what you're doing. You don't need to do extraordinary things to get extraordinary results. You just need to avoid doing foolish things when you sit down and think about investing. It helps to imagine it as planting a tree. You don't stand over the seed, checking it every hour, demanding it turn into a giant oak overnight. You plant it, you water it, and then you let time do its job. Investing works the same way. The real gains don't come from frantic activity or chasing the latest trend. They come from the steady passage of time compounding quietly in the background while you live your life. That's why the long-term view is not just one option. It's the only view that makes sense. Most people get caught up in the daily noise. They turn on the television and see markets up 200 points in the morning and down 300 points by the afternoon. That volatility tempts them to act, to sell when they're scared and buy when they're greedy. But here's the truth. If you're investing in a sound business, those daily swings are nothing more than background chatter. The stock market was designed to test your patience, not to reward impulsive behavior. Every tick on the screen is an invitation to do something foolish. And the discipline is in saying no. Think about it this way. If you owned a farm, you wouldn't wake up every morning, drive down the road, and ask someone what they'd pay for your land that day. You'd care about the crops you could grow, the yield you'd get over years, the quality of the soil. Businesses are the same. The question is not what the market will pay you tomorrow, but what that business will be worth 10, 20, or 30 years from now. If the fundamentals are solid and the management is capable, the market will eventually recognize it, but you have to be willing to wait. Patience, in fact, is the rarest commodity in investing. Everybody wants results tomorrow, yet the greatest rewards are reserved for those who are content to let compounding work its magic. Compounding is like snow rolling down a hill. At first it looks small and almost insignificant, but give it time and it grows into something powerful, unstoppable even. The biggest fortunes in history weren't made by people who jumped from idea to idea. They were made by people who picked something sensible and stuck with it through thick and thin. Of course, the long-term approach doesn't mean ignoring reality. You don't just buy blindly and hold forever without thought. You choose carefully at the beginning. You make sure the business you're investing in has an economic mode, something that keeps competitors at bay. You make sure the management team is trustworthy and capable. You make sure the product or service is one that people will still need a decade from now. Once you've done that homework, the long-term strategy is simply allowing time to prove you right. Now, people sometimes ask, what if things change? What if the economy shifts or technology disrupts the business? That's a fair question. The answer is that not every investment will last forever. Some trees grow old and rot. That's why you don't put all your money in one place, but the principle remains the same. The big money is in the waiting, not in the trading. If you hop in and out every time there's a storm, you'll never give your investments the chance to show what they can do. The irony is that long-term thinking is the simplest strategy to explain, yet the hardest for people to follow. Human nature pushes us to act, to fix things, to respond to every headline. But successful investing often means resisting that impulse. It means sitting still when everyone else is running around. It means trusting the process even when the market seems determined to shake you out. Over a lifetime, the person who buys into good businesses and holds them patiently will almost always outperform the one who tries to outsmart the market every day. And the best part is it doesn't require brilliance. It doesn't require perfect timing. It requires the temperament to delay gratification and the humility to admit that time will do a better job than your instincts in most cases. If you want investing to reward you, learn to think in decades, not days. Let compounding work while you sleep. Tune out the noise. Focus on the fundamentals. And remember that the market is a voting machine in the short term, but a weighing machine in the long term. Those who understand that lesson and truly live by it discover that wealth doesn't come suddenly. It arrives quietly like an old friend who's been walking beside you the entire time. When you put your money into something, the very least you should demand of yourself is to know exactly what you're buying. Too many people treat stocks like lottery tickets, hoping one will turn into a jackpot. But a stock isn't just a piece of paper or a number on a screen. It represents part ownership of a real business. And if you don't understand that business, how it makes money, what drives its growth, what could threaten its future, you're essentially gambling, not investing. The first rule is simple. Don't invest in anything you don't understand. If a company's operations are too complicated for you to explain in a couple of minutes, you're already in trouble. It doesn't matter if your neighbor swears it's the next big thing, or if the television experts can't stop talking about it. If you can't describe how the business earns a dollar and what gives it an edge over its competitors, then you have no business putting your money there. Confusion is costly and simplicity is safety. Think about it in everyday terms. If someone offered you the chance to buy a local gas station or a small bakery, you'd ask very basic questions before handing over the cash. How many customers do they get every day? What's the profit margin? Who are the competitors nearby? Is the location good enough to keep people coming in year after year? Yet, when it comes to big public companies, people forget those same questions and get carried away by stock tickers flashing across the screen. The principles don't change just because the scale is larger. Whether it's a corner store or a multinational corporation, the logic is the same. Know what you're buying. Now, understanding a business doesn't mean memorizing every financial ratio or predicting every twist in the economy. It means grasping the core of the business model. For example, if you look at a company like Coca-Cola, the model is straightforward. People enjoy the product, they buy it regularly, and the brand loyalty is so strong that competitors struggle to take market share. That's a business you can wrap your head around. It doesn't require an advanced degree in finance to see why it has lasted more than a century. Contrast that with businesses and industries that change overnight, where new technology can make today's winner tomorrow's loser. If you can't see the durability of a company's advantage, then your odds of holding it successfully for the long term shrink dramatically. The future is never certain, but some businesses give you far more visibility than others. The goal is to place your money where time is an ally, not an enemy. Another important part of understanding the business is evaluating the people running it. Management matters. A great business can be ruined by poor decisions, while an average business can sometimes be lifted by outstanding leadership. When you read an annual report, don't just skim the numbers. Pay attention to how management talks about challenges and opportunities. Do they admit mistakes? Do they reinvest wisely? Do they treat shareholders as partners or as outsiders to be kept in the dark? Over time, character and competence show up in results. And don't forget the competitive mode. Ask yourself, what keeps other businesses from taking this company's customers? It could be a brand, a cost advantage, a distribution network, or a product people can't live without. Whatever it is, you need to be confident that it won't disappear tomorrow. Without a moat, profits are temporary. With a moat, profits endure. That's the difference between a business that survives a few years and one that compounds wealth over decades. The temptation, of course, is to chase whatever is fashionable. A new industry pops up and suddenly everyone claims to be an expert. But if you can't explain in plain language what the company does and why people will still buy from it 10 years from now, you're speculating, not investing. Sticking with what you know isn't a weakness, it's a strength. It keeps you from wandering into areas where your lack of understanding could be very expensive. The truth is, you don't need to understand every business. You only need to understand a few deeply and well. A handful of sound investments can carry you a long way. The danger lies in thinking you need to have an opinion on every industry or every hot stock that comes along. Saying, I don't know, is often the smartest move you can make. At the end of the day, investing is about ownership, and ownership carries responsibility. If you're going to own a piece of a business, you should know it well enough that if the market shut down for years, you'd still be comfortable holding it. That kind of confidence comes only from real understanding. Without it, you're just tossing darts in the dark and hoping for luck. With it, you give yourself the best chance of building wealth that lasts. The stock market is a place that constantly tries to play tricks on your emotions. One day it rewards you, the next it punishes you, and it never feels like it's playing fair. If you let those swings dictate your decisions, you'll end up buying high when excitement is in the air and selling low when fear takes over. That's the exact opposite of what leads to success. The single biggest advantage you can develop as an investor is the ability to stay rational when everyone else is losing their head. Markets will always fluctuate. That's not a problem. In fact, it's part of the opportunity. The real danger isn't the ups and downs. It's how you react to them. When prices climb and everyone around you is celebrating, it's tempting to believe you're missing out and you need to join in, no matter what the price is. When prices fall and panic sets in, it feels just as natural to think the world is coming apart and you should rush for the exits. Both reactions are perfectly human, but they're also perfectly destructive. Staying rational means separating emotion from decision-making. It's about remembering that a stock is not a lottery ticket or a flashing number on a screen. It's a piece of a business. If the business is strong and the fundamentals haven't changed, then a decline in stock price is not a reason to sell. It's often a reason to buy. But to see it that way, you have to keep your head when the crowd is panicking. That's much easier said than done. Consider how markets behave in times of crisis. You'll hear predictions of collapse, of industries dying, of capitalism failing altogether. Most of those predictions don't come true. Yet, the fear is so powerful in the moment that people abandon sound judgment. The irony is that those very moments of panic often offer the best opportunities. If you've done your homework and you know the value of the business, the market's temporary madness is a gift, not a threat. Rationality also protects you from greed. When markets are booming, people convince themselves that trees will grow to the sky, that prices will rise forever, and that it's different this time. Those are dangerous words. No asset climbs endlessly. The higher the excitement, the greater the risk that people are ignoring fundamentals. Rational thinking reminds you that value matters more than price, and that discipline is more important than enthusiasm. One way to guard against emotional mistakes is to imagine that the stock market could close for the next 10 years. If you would still be happy owning the business during that time, then daily price movements lose their grip on you. This mindset shifts your focus from short-term swings to long-term value. And when you think that way, it becomes easier to shrug off the noise and stick with sound decisions. Another key part of staying rational is recognizing your own limitations. Nobody can predict the market's moves consistently, and it's foolish to try. The smartest investors are not the ones who forecast every twist and turn. They're the ones who admit they don't know and don't need to know. What they rely on, instead, is a clear understanding of value and the discipline to wait for the right opportunities. That humility is a form of rationality, too. It also helps to keep perspective. A downturn that feels catastrophic in the moment often looks trivial in hindsight. People who sold in fear during past recessions or crashes often regret it later when the recovery arrives. But those who stayed rational and held on to solid businesses usually came out ahead. Time has a way of rewarding patience and punishing panic. Staying rational doesn't mean you'll never feel fear or excitement. Those feelings are natural. The key is not letting them dictate your actions. Discipline is like a muscle. You build it over time by resisting the urge to act on emotion. The more you practice, the stronger it gets. At its core, successful investing isn't about brilliance or secret formulas. It's about temperament. Anyone can learn to read financial statements or analyze industries. The hard part is controlling the impulses that lead to buying when you should be cautious and selling when you should be steady. If you can master your emotions, you put yourself ahead of the majority of investors who never do. The market will always tempt you with excitement and scare you with fear. Those forces never go away. But if you can remain rational, if you can keep your head while others are losing theirs, you'll not only avoid costly mistakes, you'll position yourself to take advantage of the opportunities that panic leaves behind. That calm discipline is what turns investing from a gamble into a lifelong wealth-building tool. There's a big difference between price and value, and confusing the two is one of the most common mistakes people make in investing. Price is simply what you pay at a given moment. Value is what you actually get in return. The market throws prices at you every day, changing them constantly. But the true value of a business doesn't fluctuate nearly as much. Understanding that distinction is the key to making intelligent decisions. Imagine going to an auction where the same item is being bid up and down wildly. One minute it's going for 100, the next for 50, and then back to 150. The item itself hasn't changed. It's the same thing you saw when you walked in. Only the crowd's mood is changing. That's exactly how the stock market behaves. Every day it's filled with people reacting emotionally, and that creates a lot of noise in prices. But underneath that noise, the value of the business remains much more stable. If you focus only on price, you're at the mercy of the market's mood swings. If you focus on value, you can calmly take advantage of those swings. When a good business is offered at a bargain price, that's when you buy. When it's priced far above its worth, you stay disciplined and walk away. The discipline to separate value from price is what allows investors to avoid chasing bubbles and falling into traps. The problem is that human nature tends to do the opposite. When prices rise, people feel confident and want to buy more, even though the business may now be overpriced. When prices fall, fear sets in and people sell, even though the business may now be a bargain. It's like going to the grocery store and being upset when your favorite food is on sale and then celebrating when it doubles in cost. It doesn't make sense. But that's how emotions distort perception in markets. Understanding value requires doing some homework. You have to look at the business itself, its earnings, its competitive advantages, its future prospects, and estimate what it's truly worth. That doesn't mean you'll be precise down to the penny. Investing isn't about perfect accuracy. It's about having a sensible range of value and then demanding a margin of safety before you invest. That margin of safety protects you from mistakes in judgment and from surprises in the future. Think of it like buying a house. If you've studied the neighborhood, looked at comparable sales, and understand what the house could reasonably rent for, you have a sense of its value. If it's offered at a price well below that, you've got a good deal. If it's offered at a price well above, no matter how attractive the paint job or how excited the other buyers are, you should walk away. The same principle applies to stocks. They are pieces of businesses, and they should be evaluated with the same logic. The beauty of focusing on value is that it frees you from the pressure of timing the market. You don't need to know what the market will do tomorrow or next month. You only need to know that you are buying a good business at less than its intrinsic worth. Over time, price and value tend to converge. The market may be a voting machine in the short run, swayed by popularity contests, but it's a weighing machine in the long run. Eventually, substance outweighs sentiment. It's worth remembering that opportunities don't come every day. Markets are often fairly priced. That means you have to be patient, willing to wait for those moments when the market's mood gives you a chance to buy value at a discount. Those moments may be rare, but you don't need many of them to do very well. A handful of smart purchases made with discipline can carry you through a lifetime. At the end of the day, the distinction between price and value is not just technical, it's philosophical. Are you willing to think independently, to act when others are afraid, and to hold back when others are euphoric? That's the temperament required to put value above price. It's not always easy because the crowd will constantly pull you in the other direction. But if you can stay anchored to value, you'll find that the market's fluctuations stop being a source of fear and start becoming a source of opportunity. Wealth in investing doesn't come from chasing what's popular or reacting to every price swing. It comes from quietly, patiently buying value at the right price and letting time do its work. Price is what you pay, but value is what you get. And it's value that ultimately makes you rich, not price. People often think investing has to be complicated. They imagine you need secret formulas, complex charts, or the latest insider tip to succeed. The truth is almost the opposite. The simpler your approach, the better your results are likely to be. Complexity usually creates confusion, and confusion leads to mistakes. Simplicity forces you to focus on what really matters. Buying good businesses at sensible prices and holding them long enough for time and compounding to work in your favor. You don't get extra points in investing for degree of difficulty. Nobody hands you a medal for owning the most complicated portfolio or for using the most technical language. You get rewarded for being right, not for being fancy. A simple strategy executed with discipline beats a complicated one that you can't stick with. That's why the best investors often say their greatest strength is the ability to say no to most opportunities and yes to only the few that are clear and compelling. Think about the decisions that shape a lifetime of investing. You don't need to make hundreds of brilliant calls. You just need a handful of sound ones. A few good choices held patiently can outweigh all the noise. But if you're constantly jumping in and out trying to be clever, you're far more likely to trip yourself up. The market rewards consistency, not acrobatics. Simplicity also means staying within your circle of competence.